I've made a fortune dancing on the graves of investors who believed that this time was different. It never is. The market is about to give a whole generation of disruptors, visionaries, and AI evangelists a very expensive, very painful lesson in the laws of gravity. You look around today and you see the same hubris, the same blind optimism, and the same fundamental illiteracy that preceded every crash I've lived through since the 60s. Everyone is so busy chasing the next generative algorithm or some projection of a world where silicon replaces sweat that they've forgotten the only thing that actually matters. If you can't show me the cash today, you're just selling me a dream, and I stopped buying dreams a long time ago. The market is currently intoxicated on the promise of artificial intelligence. But let me tell you something from a man who has seen more revolutions than a spinning top. AI won't pay your interest expense when the debt comes due, and it certainly won't fill 400,000 square feet of vacant office space in a secondary market. Everyone's talking about how AI is going to save the economy, increase productivity to infinite levels, and create a new era of prosperity. That's pablum. It's the same nonsense I heard during the dot-com boom, the same junk I heard before the great financial crisis, and the same garbage people spewed right before the interest rate hikes of a few years ago started breaking things. Productivity is great, but productivity without profitability is just a faster way to go broke. In this business and in any real business, cash flow is the only truth. Liquidity is the only king. Everything else is just conversation. And usually it's a conversation held by people who have never had to make a payroll or stare down a bank during a liquidity crunch. My philosophy has always been simple, though apparently simple is the hardest thing for Wall Street to grasp. It starts with the absolute law of supply and demand. It's the only law that hasn't been repealed by the internet or a chatbot. You can have the most sophisticated AI-driven real estate platform in the world, but if there are 10 other guys building the same product and only 5 people who want to buy it, your platform is worth 0. We are witnessing a massive systemic failure to understand supply because people are blinded by the potential of technology. They think software fixes hardware problems. It doesn't. If the world is oversupplied with commercial space, no amount of machine learning is going to magically create a tenant where none exists. I've been called a grave dancer for decades. People used to think it was a morbid title, something cynical. It wasn't. It was a recognition of reality. When the music stops and the lights go out, most people freeze. They wait for a bailout. They wait for the Fed to pivot. They wait for a miracle. I don't wait for miracles. I wait for the corpses to pile up so I can see which ones still have good bones. The tragedy of the current market in 2026 is that people have mistaken stock market valuation for economic health. For 15 years, cheap money acted like a veil, hiding incompetence and masking the rot in the fundamentals. Now that the veil has been ripped away, people are desperately looking for a new savior, and they've landed on AI. But AI is a tool, not a strategy. It's a cost center before it's a profit center. And right now, the cost of being wrong is higher than it's been in 40 years. In this business, you're either the hunter or the meal. Most of the people pouring billions into AI-integrated companies are currently the meal. They just haven't been chewed yet. They're buying into companies that burn cash at a rate that would make a drunken sailor blush, all on the promise of future dominance. Let me give you a piece of advice. Dominance doesn't pay the bills. Cash flow pays the bills. If you're investing in a business that requires a miracle at year 5 to break even, you're not an investor. You're a philanthropist for the tech sector. I've always been obsessed with downside protection. Everyone wants to talk about the upside, the blue sky, the potential. I don't care about the ceiling. I want to know where the floor is. If I buy an asset at a significant discount to its replacement cost, I've built myself a margin of safety. If the market stays flat, I win. If it goes up, I win big. If it goes down, I'm protected because nobody can build a competing product for what I paid for mine. AI has no replacement cost floor. It's code. It can be replicated, disrupted, or made obsolete overnight. That's not a barrier to entry. That's a trap door. Right now, everyone is wrong about where the value is. They think because a sector is high-tech, it's safe. It's the opposite. The most overhyped assets have the furthest to fall. The illiquidity premium that people used to talk about as a feature of real estate has turned into an illiquidity penalty in the tech-heavy private markets. When everyone tries to exit through the same narrow door at the same time, the price doesn't just drop, it collapses. I'm looking at the markets today and I see a complete lack of asymmetric risk awareness. People are taking massive risks for pathetic returns, chasing a 5% gain in a tech stock while ignoring the fact that the underlying economy is struggling with the weight of debt and oversupply. The grave dancer perspective on tech bubbles is simple. It's 1999 all over again, but this time with better graphics. Back then, it was the internet. Today, it's AI. The names change, but the human stupidity remains constant. People forget that for every Amazon that survived the dot-com crash, there were 1,000 pets.coms. The same will be true for AI. Most of these companies are corpses walking around in suits. They have no moat. They have no barriers to entry. They have no pricing power. They are just features of a larger ecosystem that will eventually swallow them whole. I've always looked for the moat. In real estate, that moat is usually a combination of location, complexity, and timing. But today, the best moat is simply having the cash to survive while everyone else is drowning. Capital preservation is the name of the game in 2026. If you have the discipline to sit on your hands while your peers are out there deploying capital into AI fantasies just to earn a management fee, you're the one who will own the next decade. The urge to do something is the greatest enemy of the professional investor. I've made as much money from the deals I didn't do as I have from the ones I did. You have to be willing to look like an idiot for a year or 2 or 5 while the bubble inflates. You have to be comfortable being the only sober person at the party, because when the sirens start blaring and the cops show up, you're the only one who's going to remember where the exit is. Let's talk about the replacement cost in the physical world, because that's where the real blood is going to be. In a normal, healthy market, you don't buy existing assets for more than it would cost to build them from scratch. That's common sense. But for years, we've been living in a world where market values were disconnected from physical reality because of growth expectations. Now, as construction costs stay high and demand softens, we're seeing assets trade for 50, 60, even 70% below what it would cost to build them today. That is a siren song for someone like me. When you can buy a functional cash-flowing asset for a fraction of its replacement cost, you have effectively eliminated the threat of new competition. No one is going to build a new office building across the street if they have to charge double your rent just to break even on their construction loan. That's how you build a monopoly on value. But to do that, you have to be willing to buy when the experts are telling you that the sector is dead and that AI-driven remote work has made buildings obsolete. The reality of the 2026 office market is a classic case of supply and demand misalignment. We built too much of the wrong stuff. We built commodity office space for a world that no longer needs it. Now people say AI will solve this by making offices smarter. What a load of garbage. A smart empty office is still an empty office. A smart building with a defaulted mortgage is still a corpse. I'm watching the banks right now and they are terrified. They have billions of dollars in loans tied to these assets, and they've been playing a game of pretend and extend for 3 years, but the clock has run out. The interest rates are higher, the valuations are lower, and the cash flow isn't there. This is where I start stretching my legs. This is where the grave dancer finds his rhythm. In this business, sentimentality is the death of profit. I don't love buildings. I don't love companies. I love the math. If the math stops working, I'm gone. I've sold trophy assets that I spent years acquiring because the price was right, and I saw the clouds on the horizon. People would ask me, Sam, how could you sell that? It's a landmark. I'd tell them, a landmark is just a building that's hard to renovate. You can't get emotionally attached to brick and mortar, and you certainly can't get attached to a software trend. AI is being sold as a structural shift, but most of its applications in the real economy are just marginal efficiencies. Marginal efficiencies don't save an over-leveraged economy. Only a massive deleveraging can do that, and deleveraging is always painful. I see these young guys on social media talking about AI wealth like they've discovered fire. They've lived their entire professional lives in a declining interest rate environment or a period of unprecedented liquidity. They think they're geniuses because they bought some tech stocks in 2023. That's not skill. That's just being a passenger on a rising tide of hype. Skill is what you do when the tide goes out and you realize you're the only one not wearing a bathing suit. The next few years are going to be a masterclass in operational excellence. You're not going to get bailed out by multiple expansion anymore. If you want to make money in 2026 and beyond, you're going to have to actually manage the assets. You're going to have to cut costs, drive occupancy, and find efficiencies that the previous visionary owners were too lazy to look for. You're going to have to be a businessman, not just a deal maker. The deal maker is a dime a dozen. Everyone wants to be the guy at the closing dinner drinking the expensive wine. Nobody wants to be the guy in the basement of a distressed shopping mall in the middle of a Tuesday afternoon trying to figure out why the HVAC system is failing. But that's where the money is made. It's made in the details. It's made in the unsexy parts of the business. I've always gravitated toward the unsexy because that's where the competition is the thinnest. If everyone is fighting over the glamour AI startups in San Francisco, I'll be in the Midwest buying the boring industrial parks that actually pay the bills. Because at the end of the day, $1 of cash flow from a warehouse in Indianapolis is worth exactly the same as $1 of cash flow from a tech hub in Palo Alto. Only the warehouse costs me a hell of a lot less to buy, and it doesn't need to reinvent the world to make a profit. That brings me back to the concept of the grave dancer. To be a successful grave dancer, you need two things, a sense of timing and a lack of sentimentality. Right now, the sentimentality is all focused on technology. People believe in AI. I don't believe in anything I can't audit. I don't believe in anything that doesn't have a clear path to generating hard currency. We are seeing a massive transfer of wealth from the hopeful to the prepared. The corpses I'm seeing today are the ones who over-leveraged based on pro forma projections that were never grounded in reality. They assumed that rents would grow forever, that rates would stay at zero, and that tech would solve every problem. They were wrong on all counts. Now they are facing the reality of negative equity. When your debt is higher than your asset value, you are no longer the owner. You are a glorified property manager for the bank. And the banks don't want these assets. They want someone like me to come in and take the problem off their hands at a price that makes me a lot of money and leaves the previous owners with nothing but their vision. The reality of 2026 is that we are at the end of the greater fool theory. For years, you could buy something overpriced and sell it to someone even more foolish a year later. But the greater fool has officially gone extinct. The people left holding the keys are realizing they've bought into a fantasy. They're looking at their spreadsheets, trying to find a way to make the numbers work, and they're turning to AI as a last-ditch effort to transform their business models. It won't work. Transformation takes time and capital, and they have neither. They have debt that needs to be serviced and assets that are declining in value. That is a recipe for a funeral, and I'm just waiting for the invitation. And that invitation is arriving every single day now in the form of foreclosure notices, jingle mail, and desperate phone calls from mezzanine lenders who realize too late that they're standing on a trap door. You see, the banks aren't in the business of owning buildings. They're in the business of renting money. When the money stops coming in and the value of the collateral drops below the loan balance, the bank enters a state of existential panic. And when banks panic, that's when the grave dancer gets his music. We're seeing it right now across the entire landscape. It's not just about working from home or remote AI workers. Those are just the headlines. The underlying reality is that we are in the middle of a massive structural deleveraging that no amount of software can fix. Let's talk about where the corpses are actually piling up, because this is where the money will be made for the next decade. Everyone is looking at the big, shiny office towers in Manhattan or Chicago. Those are the obvious disasters. But the real carnage, the profitable carnage, is in the Class B and Class C office stock. These are the zombie assets of 2026. They aren't just vacant, they're functionally obsolete. They were built for a 1980s or 1990s world that no longer exists. The cost to renovate them or convert them into residential is often higher than the value of the finished product. They are effectively worth the value of the land minus the cost of demolition. Yet they are still sitting on bank balance sheets at 80 or 90 cents on the dollar. That gap, that massive yawning chasm between book value and reality, is the opportunity. I'm waiting for the banks to finally vomit these assets out. I don't want to buy the building. I want to buy the land at a price that assumes the building is a liability. That's how you reset the cost basis and create a margin of safety that nobody can touch. Then you have the multifamily market in the Sun Belt. For years, every syndicator with a social media account was telling you that you couldn't lose in Austin, Nashville, or Phoenix. They bid prices up to 3% cap rates using floating rate debt, underwritten on the assumption that rents would grow by double digits forever because tech companies are moving there. Well, guess what? The tech companies moved there, but the employees realized they don't need to live next door to the office, and the developers built 10,000 units too many. Now, the supply is hitting the market just as the economy is cooling. Rents are falling, and those visionary syndicators are seeing their equity vanish overnight as their interest expense triples. These are the corpses that were killed by arrogance. They ignored the supply and demand fundamentals because they were intoxicated by the growth narrative. I'm looking at those portfolios right now. I'm waiting for the moment when the illiquidity premium becomes so painful that they have to sell at 50 cents on the dollar just to stop the bleeding. The growth analysts will tell you that AI is going to create new types of demand for these spaces. They'll say that AI hubs will revitalize these cities. That's a fantasy. AI is capital intensive, not labor intensive. It doesn't need 10,000 people in cubicles. It needs 10,000 servers in a warehouse with a massive power connection. The distressed assets of the future aren't going to be saved by a chatbot. They're going to be saved by a hard-nosed investor who understands that if the basis is low enough, you can find a use for anything. But you have to have the capital preservation mindset. You have to be willing to hold through the illiquidity premium and wait for the cycle to turn. I've always said that I'm a supply and demand guy. That's it. That's the whole game. Everything else is just noise. Right now we have an oversupply of hope and an undersupply of reality. The tech sector has been operating on the greater fool theory for so long that they've forgotten that a business actually has to produce a surplus of cash. If you're burning $100 million a month to train a model that might one day maybe replace a paralegal, you don't have a business, you have an expensive hobby. And in a high interest rate environment, expensive hobbies get canceled. We are seeing the cancellation of the unprofitable tech era. This will have a massive ripple effect on real estate, on employment, and on the broader economy. And no, AI won't automate our way out of a debt crisis. Debt is a physical constraint. It's a legal obligation. It doesn't care how fast your processor is. The asymmetric risk in today's market is staggering. You have people buying into AI-adjacent real estate or data centers at record high valuations, taking all the risk of a new technology while accepting a return that's barely above a treasury bond. That is the definition of insanity. I want the opposite. I want to take a small risk for a massive potential gain. I want to buy the unsexy stuff that everyone else is running away from. I'm looking at grocery-anchored retail and secondary markets. Why? Because you can't download a gallon of milk, and nobody has built a new shopping center in those towns for 20 years. The replacement cost of those buildings is double what I can buy them for today. That is a moat. That is downside protection. If the economy stays tough, people still eat. If the economy booms, I raise the rents. That's a heads I win, tails I don't lose scenario. That's how I want to play 2026. I've spent my life looking for the inflection point, the moment when the consensus is so overwhelmingly wrong that the pricing becomes irrational. We are at that point with physical assets. The world is so obsessed with the digital frontier that they are neglecting the physical infrastructure that makes the digital world possible. You want to talk about AI? Let's talk about the power grid. Let's talk about the barriers to entry for new power generation. If you own the land and the permits for a power-connected industrial site, you have a monopoly. That's the grave dancer move. You don't buy the AI company. You buy the dirt that the AI company needs to exist, and you buy it from someone who is in a hurry to sell. The problem with the current generation of investors is that they haven't lived through a real cycle. They think a dip is a buying opportunity. A dip is just a pause on the way down if the fundamentals are broken. A real cycle takes years to play out. It takes time for the distressed assets to actually reach the market. It takes time for the capital preservation strategies to prove their worth. We are in the early innings of this reset. The AI exuberance is the last gasp of the old cheap money regime trying to find one more reason to bid things up. It's a distraction. My chilling prediction isn't that the world is going to end. It's that the world is going to go back to being normal. And normal means that you have to work for your money. It means that cash flow is more important than users. It means that supply and demand dictates your profit, not your vision statement. For a lot of people who have come of age in the last 15 years, normal feels like an apocalypse. To me, it feels like an opportunity. You have to be willing to be lonely. Being a contrarian isn't about being a rebel. It's about being a mathematician. If the math says everyone is wrong, you have to be comfortable standing by yourself. I've been the loneliest guy in the room many times, and it's usually right before I make my biggest scores. Right now, the room is crowded with AI enthusiasts. I'm standing outside looking at the corpses of the previous cycle and getting my checkbook ready. The grave dancer doesn't just buy anything that's dead. You have to be selective. You have to look for the assets that have a replacement cost advantage and a barrier to entry that will prevent new competition once the market recovers. You look for the distressed assets where the distress is in the owner, not the asset. If a great building has a bad balance sheet, that's an opportunity. If a bad building has a bad balance sheet, that's just a pile of trash. You have to know the difference. As we move through 2026, the focus needs to be on liquidity. Cash is not trash, despite what the visionaries told you when rates were at zero. Cash is the ultimate weapon. It's the margin of safety that allows you to sleep at night while everyone else is fielding margin calls. It's the fuel that allows you to act when the asymmetric risk finally tilts in your favor. If you're over-leveraged today, you're not an investor, you're a target. So where should you position your capital? Stay away from the hype. Ignore the AI-powered real estate startups. Look for the boring stuff that has been neglected for a decade. Look for the industrial space that serves local businesses. Look for the retail that people actually visit twice a week. And most importantly, look at the debt. There is more money to be made in the next 2 years buying distressed debt than there is in buying equity. When you buy the debt at a discount, you control the outcome. You either get paid a high interest rate or you end up owning the asset at a basis that makes it impossible to lose. That's grave dancing at its finest. The market is about to give a lot of people a very painful reality check. The AI story is just a way to delay the inevitable, but reality cannot be delayed forever. Gravity always wins. The grave dancer is ready for the music to change. The question is, are you going to be the one dancing, or are you going to be the one on the floor? Focus on the cold, hard numbers. Ignore the irrational exuberance of the tech analysts. Remember that cash flow is the only thing that pays the mortgage. If you can keep your head while everyone else is losing theirs and their shirts, you'll find that 2026 is the beginning of the greatest wealth building period of your life. But it requires the guts to be a contrarian and the discipline to wait for the grave dancer moment. If you've got the stomach for the truth, even when it's blunt and unpopular, then you're in the right place. I've spent 50 years being wrong for the first 6 months of every crisis, only to be the one left standing at the end. If you want to see how this plays out, do yourself a favor. Like this video and subscribe to the channel. I'm not here to tell you what you want to hear. I'm here to tell you what's actually happening on the ground. And if you think I'm just an old school guy who doesn't get the new economy, if you think AI has actually changed the laws of supply and demand, then prove it. Leave your arguments in the comments. My team and I will be looking through them. Show me the math, show me the cash flow, and show me the margin of safety. If all you've got is potential and projections, then don't waste my time. We're busy looking for the real opportunities in the rubble.